Good afternoon, RGV Startup Week. All right, that is not the kind of energy I drove all the way down from San Antonio to get. So I'm just not feeling the love. So let's start one more time. Good afternoon, RGV Startup Week. There we go. That's the energy I'm looking for. Hi, my name is Dr. Luis Martinez. I am thrilled to have the opportunity to be back for this year's RGV Startup Week. Hope everyone's been having a fantastic morning session and into the afternoon. I'm very excited to be able to sort of share with you all today, thinking about building a venture scale business from a VC perspective. I'm a VC. So my name is Luis Martinez, as I mentioned before. I'm venture principal at Capital Factory. We're the most active early stage investor in the state of Texas, have over 850 companies in our active portfolio, including something on the order of something like 13 unicorns. So we are VC investors, we invest, and it is something I'm intimately engaged with. We're hopefully going to go through our presentation in about 20 minutes, maybe 25, and then hopefully allow another 20 minutes, 15 minutes for conversation. Sounds good? So number one, interrupt if you've got a question during my talk. Number two, if you don't want to interrupt, that's okay. Hold on to that question. There'll be an opportunity to do it at the end. So just want to make sure we're going to have the opportunity to do some questions and some answers. Sounds good? Excellent. Lawyers are important. So I just want to make sure and clear that this is for educational use only. Nothing that I'm presenting today is meant to be legal, accounting, or investment advice. Please seek that from an actual professional that does that. The views and opinions are those of mine and mine alone for this educational content. They don't reflect the policy, the views, the positions of Capital Factory, its members, its principals, nor RGV Startup Week, its organizers, or its sponsors. And any semblance of any person, living or dead, is purely coincidental. So now that we have all of that legal stuff out of the way, it's really important to think about what is a venture scale business and what do you need to be thinking about as you're building a venture scale business. They're different than the kinds of businesses that you want to have. And it's important as you're considering building a venture scale business or any business to consider the perspective of investors. So investors are not Santa Claus. They don't give money away. They don't care if you've been naughty or nice. They don't want to give you what's on your Christmas list. They don't appear automatically, giving you exactly what you want the instant you asked for it. However, they are always watching. And it's important to be thinking about investors as you're obviously building a business, but more importantly, with regards to venture scale businesses. So as you look at the kind of range of ways in which people are funding their business, the best one is obviously paying customers and revenue. But then there's all sorts of other ranges of ways in which funding happens into businesses. There's angels, there's families and friends, there's obviously venture capital, there's private equity. There are crowdfunding platforms like Kickstarter or WeStarter. There are competitions. There's one happening this week, thanks to SupplyPay, major sponsor of RGV Startup Week, and you can win money for your company, as well as government grants and other range of other kinds of grants. So when one is talking about the kind of investors that invest in venture scale businesses, it's really important, for a little bit of terminology, to understand what an investment thesis is. So an investment thesis is pretty straightforward. It is the area of investment or the stage of investment or both that investor has made the determination of investing in that delivers what they consider an attractive return. It doesn't matter what you think. It doesn't matter what you do. If you do not fit that investor's thesis, they are not your investor. Some investors only invest in real estate. Other investors only invest in biotech. Some investors only invest in seed or pre-seed companies. Other investors invest in Series A, Series B, Series D companies. Some investors are looking for intangibles. I want to invest in companies here in the RGV. I want to invest in companies that are founded by women. I want to invest in companies that actually have and are serving veterans. Some are focused on geography. I'm interested specifically only investing in Texas or only investing in companies that have a sort of a place in both the US and the Mexican market. Some only invest at certain check sizes. 5-figure check sizes, $25,000, $10,000, $50,000. Others, their minimum check size is $5 million. So it's important to think about those factors as well as the valuation of the company. Some companies are under $1 million. Some companies are over $60 million. And so an investor knows where their check makes an impact, and more importantly, for when that return on that investment occurs, when they're going to see that outcome. And so typically, when you're talking about venture scale businesses, there's about 2 flavors of the kinds of investors that you'll encounter. If you're first starting off, chances are the very first investors you'll be speaking to will be angels. Angels are often successful exited entrepreneurs or retired business people. They are active investors. And they invest in sort of the venture scale of what's known as a pre-seed or seed company stage. Sometimes they will also do later stage deals as well, like Series A. And they are considered accredited investors. That is an official definition by the SEC that says they understand the risks of investing in these early stage companies. They are not betting their entire retirement, their house mortgage, their kids' college savings, so they can afford to kind of lose that investment that they're making. And most importantly, they have the kind of experience and understanding of this investment vehicle to be able to appropriately adjust their risk. From your perspective as a founder, how many founders have we got in the room? All right. How many investors do we have in the room? No investors in the room other than me. How many people who are neither founders nor investors in the room? Okay, so that means people who did not hold their hand up are just shy. So the most important thing that you want to think about is, as a founder, angels are investing their own money. So I've gone off, I've had a great career, I'm a banker, I'm having a great career, and I'm going to invest a little bit of my money into a company. So they're typically investing in some local connection, some niche connection, or some understanding of the industry because, they're bank people. They like to invest in financial services and fintech. So that's an important consideration. Because then there's venture capital. And what VCs do is we take money from a whole range of limited partners. These are high net worth individuals, these are family offices, sometimes these are institutions like university endowments, and we take their money and we make the promise that we're going to give them a better return than if they would have invested that money on the stock market, in bonds, in real estate, or any other kind of investment vehicle. And so we are using other people's money to make these investments in companies. We're typically not investing in the very first money into a company. That's very rare. Usually angels or friends and family are first money in. VCs are typically later stages when it comes into funding into a company, although some VCs do first money in. Some VCs typically target pre-revenue, which means they're not making any money, but there's an actual real product. Some of them, particularly those that are investing in space, in biotech, in real hard tech kind of stuff, like nuclear fusion companies, they might be investing actually in pre-product. So before you actually develop what the product is. But one of the key factors about VCs is they are hoping to seek those ventures that are going after huge, massive markets and scale. So as a founder, the most important first question you have to ask yourself is, what are you going to build? Are you going to build a bicycle, a car, an airplane, or a rocket? They're all different. They all get you from point A to point B, but they're very different with regards to fuel, their components, how they're manufactured, the supply chain, how they're assembled, how they're piloted. The training that you need to operate an airplane is very different than the training that you need to operate a bicycle, right? The certification, the computers, the maintenance, but also the speed. So I like this analogy because a bicycle you should think about as a six-figure business. 100,000, 200,000, $500,000, $700,000 a year business. A car goes faster, right? $1 million business, $2 million a year business, $5 million a year business, right? An airplane is another scale of 10. Tens of millions of dollars is the business. It's a $20 million company, a $10 million company, a $60 million company. And finally, a rocket is a nine-figure business, $100 million, $500 million, billion-dollar business is how I think about these things. So as an entrepreneur, what is your ambition? Is your goal to build $1 million business? Is your goal to build a $100 million business? They're very different. There is nothing wrong with building a $200,000 a year business. We need a lot more of those. There's nothing wrong with building a $2 million business. There's nothing wrong with that. But what's important is that for venture scale businesses, it's not only growth, but it's experiential growth and the speed and the opportunities. VCs are less interested in $100,000 businesses, $1 million businesses, because they're looking, due to power law, and having to have huge companies with huge scales. So I, as a VC, if I'm making 10 investments, only one or two will generate all the returns for that investment, which means I need to look for companies that if I put in $1, every single one of those companies has the potential of returning $20 to $30 back in for every dollar. So I can't pick the winners though. So every single one of them has to have the potential of a 20 to 30 return on the investment. So as a founder, there's a trade-off, right? You're going to be asking investors for money to go faster. You're going to be going and asking investors for money to go after a larger scale. What's your ambition? What's the trade-off? Because that's the key when it comes to be thinking about something that you're building on a venture scale. And if you're interested in VCs, VCs are interested in $100 million, billion dollar, trillion dollar companies. The only way to go to the moon or the planets is a rocket, and those are the kinds of companies that VCs are investing in. Because their hope is that one of these days, those rocket companies, maybe that are not too far from where we are today, will IPO in a not too far long time period from today. And so it is that level of return that VCs are looking for. So market matters. The size of the TAM, the total addressable market, right? The size of the SAM, the size of the SOM has to be huge. And it is a huge market that has within it a clear problem that has to be solved. And not only does that problem need to be solved, but it's got to have a significant growth potential and a beachhead market, the first place you're going to be building the first $10 million, the first $100 million, the first $100,000 that you can dominate as a company and then grow in scale to something that's greater than $100 million. So for those of you who might think about this from this perspective of like fast food or restaurants, right? Solving the I am hungry problem by starting a taco truck is not a venture scale business. Solving the, oh my goodness, we need to figure out how to make the meat patties all over the world a certain way problem that everybody's going to use to make burgers, that's going to be an interesting solution. So that's the level of scale that people are looking for. But it's more than just size. It's also like, are there tailwinds that are generating growth in that area? What is possible today in why that's going to be a massive market that wasn't true before? It could be regulatory shifts. It could be a technological breakthrough like AI. It could be a cultural change. But also, like, is like people's hair on fire because of this, right? Is the market pain so acute that customers will be happy with not quite a perfect solution because they're so desperate for what the solution is? Sounds good? So TAM is important. This is the time when most people will finish their talk. This is the time when, if you do a quick search and you think about venture scale, that page is over. Where there's a whole range of other things that you have to consider if you're going to be a founder building a venture scale business, going after VCs. So yes, huge, massive market is important. Yes, velocity, going fast is important. But then there's the smiley faces you have on the pitch deck, right? Who are these people? And why should you care? Team architecture is incredibly important for building a venture scale business. Most startups fail at the beginning, yes, because they run out of money. Yes, because they're building a product that people don't want. But they also fail because of their team and leadership. And that's a critical component that as an early stage investor, we have to take into consideration. The first 10 hires of that company dictate your culture, your speed, your execution. And so investors evaluate the architecture of that team. Can that team go 1 to 3 to 30 to 300? It's really, really important. Now, with the range of AI and the impact that AI has had in our space, we will be seeing the generation of venture scale single founder companies. That's incredibly exciting. That is one of these technological shifts that's happening. So that's happening. But team is still important. There's got to be an alignment, whether it's a team of 1 or a team of 5, between that founder's background, their skills, their personal narrative, their passion, and the massive market and the massive problem they're trying to solve. The critical question you need to answer is why you, why now? How can you or you and your co-founders are uniquely qualified to win in this specific way? If you want to build a rocket company, that is awesome. If no one has never built a rocket, that is not something that investors are interested in investing in. So it's really important to understand your team. And it's more than just the deep domain expertise. If you're going to build a space company, someone should know something about space on that company. But it's also a personal passion, experience. Have they or someone on their team experienced the pain point that they're trying to build for in that space company? Do they have a unique insight? Do they have unique networks that enable them to go in and build and scale and get hires and great talent and get customers? Can they execute? Can they get stuff done? Can they learn quickly? When that rocket blows up, take that feedback and iterate and build the next thing. So all of these factors are incredibly important to answer the question, why you, why now? The product and technology are important as well. And you've got to validate that product and technology. It can't just be on an idea on a napkin forever. You've got to turn that idea into an actual real product that's actually serving real customers. It's not a binary state of being on or off or yes or no. It's about finding problem solution fit that then leads to customer value proposition fit, which then eventually leads to product market fit. And some founders delude themselves because they look at vanity metrics. Look at how many downloads we've had. Look at all the press that we've had. Look at all the people who've hit our website. None of those things are real revenue. So the kinds of real pull that are showing you that people want to buy your product, people want to build the business, are really important. So it's critically important that you build and make something that people really want. And go back, nothing, culture, marketing, scale, t-shirts, none of that matters. It's all a waste of time until you're actually building something that people really want. Another factor is competitive advantage. What is your moat? How are you going to be better than the other person who's just as smart, if not smarter than you are, has as much money, probably has more money than you are, who's going to go after the same opportunity you want? How are you going to win? Yes, it's IP, it's patents, it's proprietary technologies, it's trade secrets, but it's also network effects, right? Do people talk about how awesome your product is? And tell other people who have the same problem, you're the person, you're the team, you're the one to go after. Are there high switching costs to go from your solution to somebody else's solution? Because if all they've got to do is send an email and get rid of you, that's a pretty low switching cost. So what are the ways in which how does it create a sticky customer, a sticky product? How strong is your brand? How strong is your delivery? How strong is the promise you have in standing behind your product? And yes, cost is an advantage. Scale is an advantage. But sometimes the race to the bottom is not the kind of race you want to be in. So what is the competitive advantage for your company at the stage that it's at? And when we talk about the competition, you can't be 20% better. You can't be twice as better. Think about being 10 times better than the competition. It doesn't have to be in every area, but in the critical way which are important for your customers, how are you 10 times better? And the response that no one else is doing this is absolutely 100% wrong. The status quo is always how things are getting done today. So you've got to be better than the status quo and better than 10 times of the people who are doing it. So don't think that if you're not first to market, you lose. That's not true. Many companies are second, third, fifth, eighth to a market 5 years later, 3 years later, 10 years later, 20 years later, looking at you, Chewy, where it's finally time for the market, the technology, the customers to adopt it. So don't think if you're not first, it's about the first to product market fit. How are you going to make money? It's super important. What are the revenue streams? How you make money? How will those scale to be $100 million, $500 million companies? What is your go-to-market? How will you reach those customers? How will you acquire those customers? If your response, people do it less now, but if your response to how are you going to scale, we're going to go viral, that is not an appropriate response. Okay? That's like saying, how are you going to become rich? And you say, I played the lottery. You know? So that is not how to scale effectively, right? But not only is your go-to-market like in a way that grows and like gets massive, does it compound over time? Does the sale of 1 lead to 10, lead to 20, lead to 100, lead to 1,000, lead to 1,000,000? And does it have the kind of lock-in that ensures there's some level of regular recurring revenue that ensures a global market opportunity? Other factors that are kind of important are 2 real simple from the software kind of like world acronyms: LTV, which is lifetime value of a customer, and CAC, cost of customer acquisition. And so you're looking for a ratio between the lifetime value of a customer and the cost of customer acquisition. And what's known as the golden ratio in SaaS is 3 to 1, right? So you should have 3 times more revenue from a customer than it costs you to acquire them, or more, right? If it's reversed, if it costs you a lot more money than to acquire a customer, you don't have a business, you have a hobby. Congratulations. Is your capital efficient in generating revenue? Is every dollar that a VC is putting in, is every dollar that an investor is putting into the business generating more business activity? Not your vacation in Cabo, not your t-shirt, not your brand, generating the business. Now, in SaaS, there's another term, and I think it's applicable for other kinds of businesses, that's known as the rule of 40. And so the rule of 40 is pretty straightforward. What's the percentage of the growth rate? And you can measure that month to month, year to year. Add that to your profit margin. Is it over 40? If not, there's things you need to look at. If there is, things look promising. But this is an important factor to be thinking about: massive growth, good, healthy margins in a way of building something. Now, question. I would love to go back. Sure. Which one would you like me to explain more? So LTV is the lifetime value of a customer. Okay, so what business are you in? Remodeling construction. Awesome. So what's the typical ticket size? Is it commercial or residential? Great. For a commercial remodeling, what's a classic typical ticket size? 50,000? 50? $50,000, right? So if one customer only does one remodel with you, that lifetime value is 50,000. But if that same person owns lots of properties and they're using you every year to redo one of their properties, or they're using you every other year to do a property, then that lifetime value is not just that one time, it's over a range of time period. So if you got one really good commercial real estate, you're his guy, you did a great job, I love it, I'm gonna use you on all my properties. How many properties does he have? 8. How many times does he remodel? He's doing about 1 a year. Great, that lifetime value of a customer is that 50,000 over 8 over that period of time for the lifetime of the business. Now, cost for customer acquisition. What did it cost you to get that customer? Did you have to spend money on marketing? Did you have to spend money at playing golf so that you could be, meeting the person? Did you have to join the Chamber of Commerce so that you could like rub elbows with the person? Like, what did it cost for you to acquire that customer? So that's that ratio of lifetime value versus cost of customer acquisition. And in many cases, many businesses fail because there's only one thing you're going to buy, right? Dr. Martinez, yeah. What about car companies? It's like, well, what about car companies? It's like, I buy about a car until it like falls apart into the ground. It's like, cool. Maybe you buy a car once every 10 years, once every 15 years, one every 20 years. That's fine. But man, do they love their Chevy? Or man, do they love their Ford? Or man, did we give them an incredible experience when they got their maintenance? Man, did we give them an incredible sort of warranty so they're going to buy the same car for their kids, for their wife, for their spouse, for their mother. They're going to buy their second car with us, their third car with us. So that's how you can think about lifetime value, even when it's a one-time transactional cost. Like, what does that look like back to network effects, or what does that look like for the lifetime? Does that help? Cool. So I'm wrapping up to the end, and then we'll get to other questions. Investors get paid when you exit. And that's a really important aspect of how this game is played. An exit is pretty straightforward. Either someone buys you or you go IPO. The truth is, venture scale businesses, most companies exit by shutting down. In fact, for almost all businesses, the exit is they shut down. So failure is normal in this business. So turns out, if you look at any kind of business, all kinds of businesses, 7 out of 10 fail. The 3 that remain, one is operating at a loss, but it's kind of chugging along. Another one is profitable. They're kind of growing a little bit, but they're profitable. And the third, the 1 in 10, is like massively doing great. That's all businesses. This term you hear about 1 in 10 companies failing, that's from the VC perspective. Because you know what? It doesn't really count if the company's losing money for me and still around. I'm looking for, didn't I mention the 20 to 30% exit, 20x exit? And it doesn't help if it's profitable or slightly profitable, right? So as a founder, if you want to be in control of your business, if you don't want to be diluted, do not take money from venture capitalists, ever, because you will be diluted. And here's an example of, and these are old numbers, of what that level of VC ownership and dilution was. When Mark Zuckerberg and his team went IPO for Facebook, the founders owned collectively 31%. Tom Klein with Sabra, the way you could sort of make your airline, thing online, 1% of the company he owned, 97% was owned by VCs. It's very rare, like with Shutterstock, to have the founders have more than 50% and control when that exit eventually occurs. So at some point, you will get diluted to the level where your board can fire you. So it's very important to understand in this game, do you want to be king or do you want to get rich? You can't do both. So if maintaining control of your company and building a large legacy company forever, like Chick-fil-A, HEB, there's nothing wrong with that. You're not taking VC dollars. So if you want VC dollars, you're looking for $100 million and more valuations in 5 to 7 years. You're building a rocket. You're looking at a TAM and a SOM that's on the scale of 100 million, a billion, $1 trillion. You want a repeatable and scalable business model where you will exit. And you need a legal structure that enables you to make that level of growth and to take that investment. And that is not an LLC. You can start as an LLC, but you're going to have to convert at some point to a C Corp in order to go ahead and get the benefits of this venture scale business. So remember, as you're thinking about building venture scale businesses, and as you're talking to investors or want to engage in investors, yes, you have to do all those things. But also remember that investor is evaluating all sorts of other opportunities as well. And you're great, and you're amazing, and you're fantastic, and guess what? So are the other 12 people I'm talking to that week. And so the question is for that investor, are you the best opportunity that fits my thesis that day, that week, that month, that quarter, that year, based upon the number of checks that I write in the spaces that I'm writing those checks at? So that's an important component. Question? So for the financial models that you as a founder would make, how do investors evaluate that? Is basically the question. Excellent. So, congratulations. You're writing fiction as a founder. You don't know what's going to happen in 10 years. You probably don't know what's going to happen in 5 either. And chances are it's kind of fuzzy after 2 years. So, yes, does it kind of make sense? But more importantly, how are you constructing the numbers? What are the assumptions that you're making that go into those financial models? Do you have a realistic expectation on what those first 2 years are going to look like, what those next 4 years are going to look like, what those next 10 years are going to look like? What would happen, and this happens typically in a Q&A and a conversation, it's like, great, here's your projection, you're going to grow 20% month over month. Yes, for your first 2 years. Yes. What happens when you grow 5%? I don't know. Awesome. Let's walk through that. Let's see what happens if you are wrong and you're not going to grow as fast as you thought you were going to run. What happens if a hurricane happens? What happens if Google enters the market and you've now got this competitor that has unlimited resources? So the financial models are important. They lead us to whether or not this is real, you're looking at a realistic opportunity or not. But more importantly is the details, and more importantly after that, the assumptions that go into building that model. That's important. Because you don't know what's going to happen in 10 years. So what we have to do is say, okay, let's take a look at 10 years. Let's look at then 5 years. Great. Let's look at 2 years. Great. Let's look at 18 months. What does that path look like? What are the assumptions that you're making in making that happen? And then let's pressure test those assumptions. Or how much have you pressure tested those assumptions, right? So great, you say you're going to go and grow this fast if you raise $1 million. Awesome. What happens if you don't raise $1 million? What then happens to the business? Yet another follow-on question? I mean, digital marketing is a component. There's lots of other things involved that you have to consider other than digital marketing, or if you're a digital marketing company yourself, the other dynamics that are happening in the marketplace that impact your business. Mm-hmm. Right. But that's just a snapshot. But that's just a snapshot for what currently is happening today and what's happened in the past. Right? How does that change in the future is really important in how one is considering the opportunities. Yes. Right. Yeah, there's a principle. It is always less expensive to keep a customer than acquire a new one. And depending on the industry, it's anywhere between 50% less expensive to 10 times less expensive to keep a customer than to acquire a new one. So the level of sticky customer is really important as well. That's a really great question. We've got some time for some additional questions in the room. So yes, let's hit it. Yeah. Oh, sure, 100 times, 100 times. There's this little company called McDonald's. You might have heard of them. They have golden arches, right? They just started as a hamburger stand, right? That turned into this massive billion-dollar industry. Yeah, and this is what's fantastic about the journey, right? You get to choose as a founder. You get to sit here and say, you know what? I'm just fine with one burger stand. It's like, awesome. No, you know what? Everyone wants this, I don't know, what a burger. It's right here. So it's really important to understand in your journey, you can always change your mind and throttle up your ambition. You can also throttle down your ambition. But you as the founder, when you start your journey, should understand what your goals are. Are you starting to build a rocket? Awesome, because you're going to want to be building the components, the speed, like what it takes to build a rocket kind of business. That's a very different kind of business than a $100,000 bicycle business, right? A $100,000 bicycle business, super easy, super fast, super inexpensive to stand up. You probably can have AI do that tomorrow automatically, right? $1 million, $100 million business, that takes a little bit more time, you know? So that's why it's important to, number one, when you start the journey, what's your ambition? So that you have in place the components that you need to pull together to match that ambition. And then you want to get money from folks like us to be able to have the kind of proof points that you need that enable us to say, yes, this is how we're going to do this with other people's money. or how a person who's an angel is going to invest with their own money. Yes. Yeah, it changed a couple of things. So COVID, because the world went virtual pretty quickly, it was a lot easier for people to invest on Zoom calls than it was for people to meet face to face. So that's the first thing that changed. The second thing is that people that were looking, us included, who were looking at a tight kind of geographic focus, were now beginning to invest much more broadly in wider areas. So that's the second change. And then there's a whole range of other changes that COVID brought on board as well. There were talent flow changes in how people kind of moved and left. A lot of San Francisco people left San Francisco because of COVID, and they were in Denver, they were in Austin. A lot of New York people, because it was COVID, aren't in New York anymore. They were in Miami, right? And so, like, this kind of flow of people that were in typically the centers of where that activity is, San Francisco, Boston, New York, LA, spread across the other parts around the country, and have led to all sorts of VCs being all over the country right now. So those are two important COVID impacts. Yeah, I mean, I think for some investors, it did lead to, like, how is this going to change the world? And it has led to that kind of change in investment strategy. Um, we've seen a lot of investment shifts since COVID in the last 6 years towards solidifying the supply chain here in the United States, for example, manufacturing here in the United States, for an example. Trying to build resilient supply chains is an example. So there's lots. The current conflict is another example of, like, why being tied to certain kinds of resources or certain kind of regions can have an enormous amount of risk for your business or risk for that market. So, like, there are VC shifts that are looking to kind of, like, address those opportunities. But the more immediate ones were sort of in the way that they operate, or the two that I mentioned before. There was also a lot of activity that VCs did during those years. Yeah. AI is still hot. It's a phenomenal area that people are investing in. Though we're beginning to see, thanks so much, we're beginning to see a shift in how those investment dollars are happening. So fundamentally, AI supply chain, AI fundamental models, AI infrastructure, they're getting a lot of investment. The kinds of physical AI is getting a lot of investment. The kind of, like, hey, AI to help you do X, Y, and Z, the kind of bottom is falling out of that as an investment opportunity, because it's just, there's so many of those things now that so many people are chasing after. Many VCs have already made investments in those spaces. There's a perception that AI is a bit frothy, a bit bubbly in sort of a market, that people are staying away from the kind of investments that they used to be making in that space, like they were making 4 years ago or 5 years ago or 3 years ago. Great question.